Looks like the time is about right. I know we got a few more people that's going to be coming in, but let's go ahead and get started. Welcome everybody to the July 27th edition of Mr. Ray's Real Estate, presenting to you Minority Real Estate Millionaires. This is where we're teaching people how to become real estate millionaires. And today I want to talk about the 5 ways that you get paid when you hold real estate. The 5 ways that you get paid. This is very, very important. I don't know many asset classes that pay you 5 different ways, but I'm going to show you today that in fact, that's what real estate does for you. See if I can get it started here. All right, so our agenda for today, we're going to talk about the 5 ways we get paid. I might have time. If we have time, I want to give a little status update on the Madison property, and then also a status update on the Ballard property if we have time. If not, we'll push that on over to Thursday. But I want to talk a little bit about, let's start off, I want to get everybody set straight on what we're talking about today. So before I get into the 5 things, I want to have a little discussion around understanding taxes and this whole thing about capital gains tax. So when you buy your home, the home that you live in, and if you live in that home for less than a year and you sell that home, the IRS will tax you on what they call a short-term capital gains tax. That means whatever your tax rate is, anywhere from 0 to 20%, that's what you'll pay on that house. Let's say you bought the house for $70,000, you sold the house within a year for $100,000. That $30,000 now is taxable at the capital gains short-term rate. So not sure what your rate is. Most people anywhere between 15, again, 20%. Now, in the long-term taxes on an individual home, if you live in it for at least 5 years, if you've held the home for 5 years, but you've lived in it for at least 2 of the last 5 years, then the IRS says if you make money on that home, the difference between what you paid for and what you bought for, what you paid for it and what you sold it for, that difference, let's say you made $50,000, that would be exempt from capital gains tax. For single people, the first $250,000 is exempt. If you're married, $500,000 is exempt. So anybody got any questions on that capital gains tax? It doesn't work with you, it works against you, big baby. Also, when we're talking about understanding taxes, there's 2 types of depreciation I want to talk to you about today. There's what I call the negative depreciation, and that is that when you own assets that depreciate, they lose their value. For instance, if you bought a new car today, a 2020 car today, you drove it off the lot, it's immediately not worth what you just paid for. Even if you turned around and drove it right back to the car lot, they wouldn't give you what you just paid for it. It has depreciated, and I call that negative depreciation. So things like cars and furniture, even your iPhone, computers, and things like that, as soon as you buy them, they depreciate. That means they're no longer worth what you just paid for them, okay? And so eBay and others are making a killing out there selling stuff aftermarket, stuff that has depreciated, and therefore you get a deal on it, right? But also there's this positive depreciation. And this is a depreciation wherein the IRS will allow you to take a credit for holding these types of assets. And in particular, we're talking about real estate. So we're going to be talking about this positive depreciation that the IRS will allow you to take advantage of when you are an investor in real estate. So let's talk about some different asset classes, right? There's certain ways that you get paid when you have certain assets. For instance, stocks. If you buy a stock, the goal is to buy low and sell high, right? I want to buy it for $50 and I want to sell it for $100 and I want to bank that $50 profit, right? Well, that's one way that you make money on stocks, okay? The other way that you make money on stocks is a company will pay you dividends. That is, they will pay you a percentage of the earnings that they make, and they'll pay that out to you quarterly or monthly. All right, so there's two ways that stocks pay you. Again, we're not talking about volatility or anything else. We're just saying this is how you get paid. Bonds, they pay you interest. If you buy a bond, there's a certain interest rate that you get, and so they pay you that monthly or quarterly. And then the other assets, gold, silver, anything else, is again, you have to buy it low and sell it high to make money. If you buy it high and sell it low, you lose money, right? And so I just wanted to give you some idea around the different types of asset classes and how they pay you. So anybody got any questions on those assets? Now, that's not all asset classes. I'm just talking about things that we're currently familiar with. Very good. Now, this is very key right here because real estate is just one of the things that banks will loan you money on, right? Banks normally won't loan you money to go buy stocks. They won't loan you money to go buy gold or bonds or things like that, right? Banks will loan you money to buy single family houses, to buy commercial buildings, things of those sort. And what that is, when the bank allows you to borrow money on their behalf, that's called leverage. And when you look at leverage, the definition is it's an investment strategy of using borrowed money. That's what we're doing as minority real estate investors. We're borrowing money and we're using that money to increase the potential return on our investment, which is real estate, right? So we're basically using other people's money. That is the magic of being in this real estate business. You get to leverage other people's money, and they in turn help you make money. Hopefully, you're increasing the value of your investment. Again, OPM, that's good, baby. You want to use other people's money any chance that you get. Any questions on leverage? Do we understand what leverage is? All right, let's keep it moving then. So this leverage thing is huge, and I always use this particular slide. So I'm showing the difference between if I had $100,000 to invest in the stock market or $100,000 that I can invest in real estate, okay? So we use that example in the stock market. I'd invest that whole $100,000, right? And hopefully I will get a return. Let's just assume in this case that I'm gonna get a 10% return, right? On that $100,000 investment. So I have a 10% return, all right? Again, I don't control the outcome of that. The market goes up and down, whatever. I can't control that. But if the value of the property of the stock goes up, then I get that 10%. Now let's look at real estate. Let's say I still had $100,000, but I'm only going to use $20,000 of that $20,000 of that $100,000 to buy a $100,000 property. Well, how does that work, Ray? Well, I just go to the bank and I say, I want to put down 20% on this $100,000 property. I want you to finance the rest. The bank looks at my credit, looks at all my other stuff and say, good, we'll do that for you, Mr. Whitley. You look like you know what you're doing. And so let's just assume that property, let's just assume that property gave me $6,000 return at the end of the year. So I would earn 6% return on that, right? But think about this. I only use 20,000 of my 100,000, right? So that 6% divided by my 20,000 actually gives me an enhanced return, right, of 30%. On the stock, it went up 10%, and my return was 10%. On the real estate, it went up 6%, but my actual return on investment was 30%. That's due to the fact that I leveraged $80,000 of the bank money to get an additional return. And also, I get to control the assets. So again, that leverage is powerful. It allows you to, and so I could take that same $100,000 and I could put down $20,000 on 5 different houses and get that same return and really maximize my return on my assets, as opposed to I just put the whole $100,000 in the stock market, maybe several stocks, but I got the whole 100,000 in there. Whereas if I put $20,000 per house, then I got 5 houses, right? And I probably got $500,000 worth of real estate by using leverage. That's a great thing, leverage. Any questions on that? All right, so let's get into our conversation. We want to talk about the 5 ways that a real estate investor gets paid. I love this. I love getting paid 5 different ways. So let's talk about the first one is property appreciation. That is when the value of your property, real estate, goes up from year to year. And we've seen, for the most part, that the values in real estate does go up year over year. There's also a way you get paid, what we call the loan pay down, right? As you're paying off that 80% loan that you just got from the bank, you're paying down that loan. But really, it's not you paying it down. If you're leasing the property, your tenants are paying the loan down. The other way that you get paid is you're increasing your equity. As your appreciation goes up and your loan, the loan goes down because you're paying it down, you're increasing your equity in that property. And that's another way that you get paid. And let's not forget the tax benefits. And I want to go over in detail all the tax benefits that you get from investing in real estate. We talked about depreciation, but I want to show you how that works. And then, oh yeah, there it is right there, baby, the cash flow. Fall in love with them numbers. That's what we're here to talk about, getting those numbers right. But as you see here, these are 5 ways that you get paid in real estate. I don't know of any other asset class that pays you 5 different ways. So let's look at the first one, property appreciation. When we talk about a property appreciating, what are we talking about? So real estate is one of the few assets that appreciate over time. Now I know some would say, well, there's other assets. I see all these old time cars out here. The guys be selling them. You know, they fix them up and they bring them back. Yeah, but normally that's not the case. You got to hold those old cars for 20 and 30 years before you see the value goes up, right? You're just not driving them off the lot and they're going up the very next year. We just talked about most vehicles like that are depreciated. But in real estate, the longer you hold it, the more it goes up in value. And I just threw a bullet point out here that the average price increase for single family homes could be plus or minus 5% annually, right? Well, you don't know, you just have to look at what the market is doing for the houses that's selling around you. You can determine what those values are. So let's look at an example. Let's say I bought a house on January 1, 2019. It was worth $100,000. 1 year later, if I went back and look at that market value, let's say it was now, oh, that property is worth 110. Guess what? I just got $10,000 increase in appreciation. That means there was a 10% increase in the value of that property. Now, 10%, that's a lot increase in 1 year. You normally don't see that. You normally see 1 to 5% a year. But just an example, in this particular case, you see a 10% increase in appreciation. So that's the first way that you get paid in buy and hold real estate investing. Now, the second way that you get paid in real estate is what we call the loan pay down. And I'd like to thank all of my tenants for helping me pay down my loan on all my beautiful homes. Beautiful, beautiful homes. I love you, my tenants. So let's look at an example here of how this loan pay down pays you. So we got a loan for $100,000, 5%, 20 years. We're paying about $659 a month, right? But we're not really paying, and our tenant is paying. Let's further assume that first year payments, that's $659. If you multiply that out by 12 months, that comes up to $7,919. Of that $7,000 that you paid in that monthly payment, $4,900 of it was interest and $2,900 was principal, right? The part that you pay down, the interest, you get to write off on your taxes. The principal is what now becomes part of your equity because you paid that loan down $2,900. Now that loan balance after 1 year is about $97,000, right? So you are in fact building equity as you pay that loan down. Again, if you had a $100,000 loan, right, and after the first year is now $97,000, you have reduced that loan again by $2,900. You now have increased your equity. Any questions?
Hey, Ray.
Yeah.
Do you prefer to go for the standardized deduction or itemized for your properties?
What do you mean, standard or itemized?
When you're filing your taxes, the standard deduction that they allow, basically just summing it all up to what is, I forgot the numbers. I think it's 12,000 if you're single or head of household.
I'm an itemizer because I got all these properties, right? So my for my LLC, I'm gonna get a K1 that's gonna actually go through and show all my expenses, all the income on my properties. At the end of that, when they add all the properties up, and let's say I made $10,000 with all my properties that year, they would add that $10,000 to my adjusted gross income, and that would be the income they would tax me on. If I had a loss of $10,000, they would take $10,000 off my adjusted gross income, and that would be it. But no, I don't use the standard deduction. I will always take the itemized, and there are some thresholds for that. I think you have, depending on how much money that you're making, and how many, what the type of deductions that you have, whether you have interest, school loans, things like that. That's going to determine whether you're going to take the standard deduction. If you can't meet that $12,000 threshold, I believe that's what you said, and I believe that is right, then it's better off for you to take that the $12,000. But if you got expenses and things that exceed that $12,000, then you want to take the itemized. Hope that answers your question. All right, so we've looked at 2 ways we got paid. Now let's look at the third way that we're getting paid. When we talk about equity, equity is the difference between the market value and the loan balance that you have on that property. For instance, again, I have a $100,000 home, that's the market value. I have an $80,000 loan on it. The difference is the $20,000 is the equity I have in that home. That means that's worth, that's how much that property is worth to me, less if I take off the loan, right? So I got $20,000 in equity. And 2 ways that equity increases over time is the home increases in value and the balance of the loan goes down. Both of those working together are going to increase your equity over time tremendously. So that's huge there. That equity, big baby. That's why you see people taking out these lines of credit, these home equity loans. They got all that money sitting in these properties, and now they get an opportunity. The bank will allow them to take some of that money out of those properties and use them for whatever they want to. A lot of people use them to fix up their homes. A lot of people just take vacations with them. Some people buy second homes with them. So that equity is worth something, right? And that's another way that you get paid. All right, let's talk about the tax benefits. Now, I need to talk about depreciation here because some people have the wrong view of depreciation. Real estate is one of those things that allow you to depreciate the value of the asset over time, right? The longer you hold the property, every year you get to depreciate it. The IRS has determined that you can depreciate real estate investment property over 27.5 years. That's what the IRS will allow you. So they allow you to deduct that each year off of your taxes, which is huge. So let me give you an example. So let's say, again, we used a $100,000 purchase price. If you take that $100,000, you divide it by 27.5, that means that every year you get to deduct $3,600 from your taxes. That's a sweet deal, baby. That's a sweet deal. For doing nothing other than owning that property, the IRS is going to give you a credit of $3,600 just for owning that property. Great deal, baby. I love it. That's why I love real estate. IRS encourages you to buy rental property and real estate investments. But let's keep going. That's just one of the benefits that you get when you invest in real estate. Every expense that you have for that property is deductible dollar for dollar. When you buy the property, there's points, there's closing costs, there's things like that. All that is deductible. All that mortgage interest that you're paying or your tenant is paying on your behalf is deductible. Your real estate taxes are deductible. If you have traveling expenses associated with your business, looking at property, fixing up property, whatever, you get to deduct those. Advertising expenses, insurance expenses, professional fees, capital, all your maintenance and repairs. And we already talked about depreciation, mileage, office. I mean, the list goes on. Any dime, dollar, nickel that you spend in real estate, you get to write it off dollar for dollar on your taxes. What a deal. What a deal. I don't know any other investment that's doing that.
Hey, Mr. Ray.
Yes, sir.
Is that if you have an LLC, or can you do that as an individual?
You can do it as an individual. You don't need an LLC to do that. You just need to keep separate books from your personal and your business. So you can have one property and you get to take all of those expenses for those properties. For that property.
What if the Latino just deal with cash and they don't have receipts and stuff like that?
You're gonna have some receipts, big buddy, to be able to just you can write a receipt for them. You can still, but you can write all the receipt for them to show that you did expend that amount of money. So you can still write it off. Just write a receipt for them.
Perfect. Thank you.
Yes, sir. I'm here to help. Anybody else I can help out there today? Somebody's learning something out there today. Some of y'all didn't even know what you didn't know. That's the beauty of real estate. These tax benefits are huge. I can tell you the first 5 years that I started investing in real estate, when I was working at OG&E, I was in the 39% tax bracket. That means every time I got the W-2, by the time they got done, I would state, local, federal, SDI, I mean, all these other, I was paying 39%. That means if I made $100, they was taking $39 in taxes. When I got into real estate, after 5 years, my tax rate dropped to 12%, simply because now I get to write off all these particular expenses that are associated with real estate investing. What a deal. Beautiful.
So you telling me if I purchase points from the bank or whatever it is to lower the interest rate and so on and so forth, and I can go closing costs all into that for taxes.
I believe that is correct, sir. I'm going to check now that I looked at the points. I know there are a lot of the costs that are on that closing cost, you get to deduct. You got taxes in there that you're paying, your insurance that you're paying on that. I believe that the points are, I'll check on that and I can get back with you, but I believe I did deduct those costs.
Okay, what do you need to keep as far as records for when tax time comes, whenever you're purchasing and doing all this stuff to have on hand to file?
Like, you mean just for the when you buy a property or all these expenses?
All the above, when you buy a property, and for these expenses here, I mean.
All you got to do is have receipts. Show that you paid it. That's it.
Hey, Ray,
Yeah.
when I have somebody who's like, well, I don't have a checking account, I can't give you a receipt, I write them a check and then I have them endorse it and I cash it for them. So I've got my paper trail that I paid them, and it doesn't matter if they don't report it. It doesn't, none of that matters.
Yeah, if you pay by
I've got my
check,
check.
if you pay by check, that's bona fide evidence right there. You have a copy of that canceled check, that'll work. Any other questions on the tax benefits? They are huge. Let me tell you, it's huge. Oh yeah, baby. Now we talking cash flow. This is the other way that we get paid in real estate. And this is the one I love. The net cash flow, baby. You're getting paid every month, and your tenant is paying all of that for you. What a beautiful thing. What a beautiful thing, right? So net cash flow, we don't have to go through that. I've taken you guys through enough of those examples. Make sure you run your numbers. Make sure you know that you cash flowing. When you make money when you buy the property, you don't make money when you sell it, right? All right, so let's look at an example of how all this comes together. The 5 ways that we get paid. I'm gonna wrap it all up in one good deal. Okay, so here we go. So we bought a property for $100,000. We put $20,000 down. We financed $80,000. The monthly rent was $1,000. You see the taxes, insurance, maintenance, all that stuff. At the end of the day, I'm cash flowing $234 after I pay everything, okay? So just keep that in mind, and I'm gonna show you how this works right here. So that same example. So let's just assume that the property went up 1% that year. It was worth $100,000. It went up 1%. Guess what? I got $1,000 appreciation. I can put that in my account. Now that's not real money. I can't cash it. I can't write a check on it, but I do have increased value, right? So in my mind, I got paid. The other way I got paid is I paid the loan down. The principal reduction was paid. I paid $2,257 in principal reduction, right? So my appreciation went up, my loan went down. Guess what? I have equity increase of $3,257. Great. That's not it though. Now I have to add in my net cash flows, right? Remember, I was making $184 something a month. On an annual basis, that's like $2,800. So before taxes, I got money in the bank. Now I don't have the appreciation in the bank. The loan pay down is there. The equity is there. My cash flows are there. So I'm about $6,000 to the good right now. That's before I get ready to do my taxes. Now I take that same $100,000 house, I divide the 27.5, and I get 27.5 years. I get the $3,636 that I'm going to immediately get credit for on my taxes. Oh, but that's not it. That's not it. All those expenses that I had for the year, the taxes, the insurance, the interest that I paid on that loan, the maintenance, the utility, everything. I'm gonna write that off too. So now I got $13,000 that I'm gonna get credited, right? But if I look back at my deal, well, man, I only made, looks like I made 6,000, right? But then when you look at my taxes, it looks like I'm losing money. That's the beautiful thing, right? On paper, looks like I'm losing, but really, I got that money in the bank, right? So you want to show a loss because, let's say in this particular instance, that $7,000 is going to show up in my K1 for my LLC, and it's going to transfer over to my personal taxes, and they're going to deduct $7,600 off of my adjusted gross income due to what it shows to be paper losses on my real estate. Any questions? That's huge, baby.
I got that is huge. Oh my goodness. Okay, so what about if you did a home warranty and you paying for that home warranty?
Deducted. Absolutely, it's an expense. It's like insurance. That's all it is. It's insurance. What else? I mean, you guys understand the significance of getting paid 5 ways and then having $6,000 in your pocket, but it looks like you're losing $7,000. The government's letting you just take that money right off the table. I mean, this is a beautiful thing, people. It's beautiful. And you keep doing this time and time and time again, before you know it, you are a real estate millionaire. I'm telling you, this thing here is serious. This is how you change lives. This is how you change your legacy. This is how you change from being a worker bee at work, working for the man, to working for yourself and getting significant tax benefits from being your own boss. Huge, baby. Who's down with OPM? I'm down with OPM. You down with OPM? I'm down with OPM.
They might be too young, Ray.
You really want to say OPP? I can say other people's paper. How about OPP? We're down with other people's paper, baby. That's what's up. That's all I got today, man. I was going to take y'all through ballot. And I think I'm going to save that. I was going to show y'all some numbers. That ballot deal is going to work out great for me. Some of y'all came over and y'all saw the property. Again, it's about ready. We're going to have in fact, this Thursday, I'm inviting everyone out to the property on ballot, 1805 ballot, 6 p.m. this Thursday. And we're going to finish up that property. I got a few things I need to finish up on, some touch-up paint. I got some cleanup project. I got, and so I'm inviting any and all that want to come over and help Mr. Ray finalize this property. We're going to have some fun. I'm bringing the beer. I'm bringing the pizza. I'm bringing the Cokes, the water, whatever it is. We're going to come over. We're going to get some work done. But we're going to have a good time also. So I'm inviting everybody over next Thursday at 6 p.m., 1805 East Ballot, baby. We're going to get it in. We're going to finish this project out. We're going to put it on the market, and we're going to make money, baby. We're going to make the money. Any questions, comments before we get off of here today? Was this helpful? New stuff, old stuff? You already knew it? What's up?
Yep,
This
good
is
job.
extremely helpful. Thank you.
Good, good.
Yes, good info, Jeff.
Yes, sir. All right. So what I want you guys to do is to send me a text and let me know if you're going to be there Thursday, because that way me and the wife will know how much pizza to get, how many beers to get, stuff like that. So just shoot me a text if you're going to make it, and I will see you there. With that being said, we're wrapping up another Monday session. You know, if this virus wasn't like it was, I'd be getting you guys together personally. But I think right now the virus still spreading. We're going to continue to do the Zooms, but at some point we're going to be able to do some activities together. I'm going to be bringing us together to do some activities so we can get to know each other, so we can grow together. So with that being said, this session is over. Everybody have a great day. We'll see you next time. In fact, we'll see you Thursday. God bless. Meeting has ended.